This podcast is for entertainment purposes only and should not be relied upon as the basis for investment decisions. Podcast guests and their clients may maintain positions in the securities discussed in this podcast. Hello and welcome back to the Three Wise Monkeys podcast, a weekly podcast that's all about the markets and investing. My name is Andrew Page, founder of strawman.com, and today I'm joined by Matt Joss from mattjoss.com. Hi, Matt.
Thank you, Andrew. I'm reasonably happy to be here.
Reasonably happy is about right. As you can probably tell from our voices, neither of us are feeling particularly chipper today.
Yeah.
And poor old Claude's suffering from a lung infection as well. So, we are not at full strength, but the show must go on. What are we going to talk about today?
Yeah, so today going to talk through picking over the crypto wreckage.
Crypto wreckage.
The crypto wreckage, yeah. You're, I believe, going to run us through Woolworths, who's just had a bit of news come out. They're pretty cashed up and a bit of a change of strategy, and we'll see what they're going to do with that cash.
Fair bit of news there. Yep.
Absolutely. And lastly, something I've been looking at over the past few weeks is financial shenanigans and accounting shenanigans that can happen. Something I've been looking at, how can I measure that quantitatively. Just going to talk through some of the stuff that investors can watch out for.
I love that as a topic. There's a lot of things that I know now that I wish I'd known earlier. Probably could have saved me a pretty penny or two. So looking forward to that. But let's start off with picking over the crypto wreckage.
Yeah, absolutely.
Well, wreckage is probably putting it lightly. 2017 was just, do you remember you couldn't get into a cab, an Uber, or barbecue? Like everyone was talking Bitcoin.
You know, yeah. I mean, thinking about this, I was actually thinking, do you remember that trip we did for the Gold Coast?
Yep.
And so Andrew and I went up there, and I think two different Uber drivers both just randomly started talking to us. This was in like December 2017, so the very peak. Two different Uber drivers talking to us about what to invest in crypto, basically.
Yeah. We didn't say what we did for a living or anything. It was we were just right into crypto.
On the plane back, I was just sitting there looking at some charts of my stocks, right? Like of my portfolio or something.
Yeah.
And whatever chart it was must have been going up because the guy sitting next to me just goes, "Hey bro, you into crypto?" Like just everywhere I was just bombarding, and I didn't own any crypto. This is when it was up like, I don't know, 1,000% that year or something. So no,
it was crazy. And I think it's safe. Is it safe to say now, like without being subjective in any way, shape or form, that was just a massive bubble?
Yeah, absolutely.
Like,
yeah.
It has to have been, right?
Yeah.
So how much has Bitcoin come back from the peak? Do you know?
Yeah, so I checked out the numbers today. So Bitcoin got up to 19,780 USD, and it's now about 4,100. So it's down about 80%.
That classifies as a popped bubble.
Yeah, it's pretty popped. The whole market, I think, got up to, so all cryptocurrencies got up to about 830 billion at one stage.
Wow.
And now down to about 140-ish billion, so down about 70% overall. So it got pretty hyped. You could see it everywhere. Every man and his dog literally probably was buying coins at one stage. And it's all kind of, the tide has gone out now. Yeah.
So we thought, not that we're trying to reinvigorate that craziness, and it really was crazy. I mean, it had all the ingredients of a bubble, didn't it? It was just like, there was a huge amount of FOMO at play. Yeah. There was, like any good bubble, there was some certain nuggets of truth to all of this that sort of set the groundwork. I tried to make an effort at one point, thinking, I've got to get my head around this. And I was really hard. Really hard. And yet it didn't seem to matter to most people. It's like, nah, don't worry. It's the future. It's technology.
It's very frustrating because it's very hard to really understand, but it was at the time easy, seemingly, for people to make a lot of money not understting it at all.
And people made a lot of money. And here's the other. So what was interesting about it is, okay, it got crazy. Things have pulled right back.
Yeah.
But it's still well up on where it was.
Yeah.
And there's like the market cap of crypto is actually
still 140 billion.
That's a huge market.
Yeah. Yeah. So that's kind of got me interested, I guess, in looking at the space again. So it's over the past, it's been down almost 18 months now, I guess. So it was kind of January in 2018 that it popped, you could say. And it's kind of stabilized, I guess, now. But so for me, it's been kind of like picking over the wreckage, as you could say, trying to figure out, is there something in this space that is worth investing? Because just like the dot-com crash, right? There was a lot of hype and things got crazy.
Yeah.
But there's a lot of good companies that still came out of there. And if you'd been able to buy Amazon in the wreckage of the dot-com crash, you'd be a multimillionaire almost no matter how much you put in.
And by the way, like all of the big narratives of the dot-com boom were true.
Yeah.
Like commerce is going to change. The economy is going to change. Everything is going to be online. And sort of like, well, you fast forward to now and, it was absolutely true.
Yeah.
So with a lot of the hype now gone, maybe there's something to be said for crypto.
Yeah, so I've been looking over the space. To me, the main things, it's not radically different from my investing in the share market is the way I think about most investing, I guess. So for me, it was really, I guess, spending some time to get my head around it because, as you say, there's like a steep learning curve just to figure out how to buy the stuff. But I look for the same type of thing. So I look for companies that have, I guess, that make logical sense why they need to exist. And there's a lot in the crypto space that didn't. But then that also have users and traction and adoption.
Yeah.
And that's
been validated in some way.
Exactly. Yeah. Like there'd been a lot where there'd been a lot of people speculating on it and they'd raised other crypto money in this kind of circle, the self-perpetuating loop, just like back in the dot-com days.
Yep.
But there weren't too many that had real users. So that's what I've been looking at over the past few months. And so a few that kind of areas that I think are interesting. So why I think it's even worth thinking about at all is there are, as you said, some genuine technological improvements. The first, which is quite strange to think about, is that Bitcoin allows for scarcity. Well, Bitcoin crypto allows for scarcity and digital resources. So normally one of the great advantages why we love software is it's very easy to have a infinitely replicable with zero marginal cost. It's basically abundance and free. You can send that pirated MP3 to everyone on Napster and, to play that forward.
Yeah.
But crypto currencies and the blockchain, I guess, allows for scarcity, which allows for things like money. So Bitcoin is basically digital money, right? Or attempting to be.
Yep.
Well, the use case that has stayed around so far is the idea of using it like gold. So that's where a lot of this thing is like a store of value, which isn't so good when it's down 80%. But
a little bit of irony there.
Yeah, but it has sort of, as you say, still stabilized at a total market cap of all of them for about 140 billion. So it's still big.
Well, you can say the same about gold, right?
Yeah.
Like gold's had big sort of bubbles and fallen away.
Yeah,
it's still
and
regarded as a store of wealth.
I imagine when gold was first introduced, it probably took a while before everyone 50,000 years ago got on board. So there's probably some peaks and troughs along the way.
Yeah, for sure.
But that's not the use case that interests me the most. So I like more real world practical stuff. I guess if that was being used as a currency, that might be interesting, but it's not.
Yep.
So there aren't too many though, unfortunately. So I've scoured the space. There's very few that have more than a handful of adopters.
Okay.
And the other thing to me is to think through like what's a practical application of that.
What problem is it solving?
Exactly.
Yeah.
So there's one which I'm not advocating in any way or own, which is digital collectibles. So that's a scarcity thing. So like crypto kitties, you might have heard, which is literally like,
I haven't.
Imagine a collectible soft toy, but in digital form.
Okay.
That is one that has continued usage.
Okay.
And at some point, there's probably some kitty that was worth like $1 million or whatever. Like trading cards.
Wow.
Imagine
okay.
like trading cards.
But that is impossible to copy.
Yeah,
like
exactly.
You have
that.
one of X.
So that's like kind of interesting, but not much real world. Again, you're
Right.
still getting back to the same currency space. One area that kind of interested me more broadly is forecasting. So there's a few businesses out there. So I think forecasting is interesting because you could make a forecast, put it on the blockchain or whatever blockchain technology you're using, and that's kind of an eligible, an immutable record of what that forecast was. So
Right.
when we think about forecasting, what the big problems with tracking people is they say, I didn't mean that, or, like I didn't say that, or they make so many. So that's like something that I think can add real value is this immutable store of information that you can go back and track automatically how that performed.
Yep.
So it's like an area that I think interests me within crypto.
Is that similar to the use case for some of the cryptos in contract purposes as well? So you and I, it's almost like we make a bet, for want of a better word, and we now have, an immutable, inarguable source of what we agreed upon?
Yeah, it is. I guess the tricky part with contracts is you still need a government to enforce that normally.
Oh, okay.
You need, for that
you
to
can
work.
Still go, no.
Yeah, pretty much. I think you need it to work. You need to have the thing that you're contracting about be digital and recognizable as well. So say that I contracted with you to sell a house. There's no real proof on the blockchain that I gave you the house. There's no digital way to do that.
Yeah.
For some digital asset, there would be. There hasn't been a good use case. So that's a tricky one.
Gotcha.
There's a couple of crypto coins, whatever you want to call them, out there, projects. Augur is one where it's just like a betting market. So you can say, it's kind of like Betfair, but completely decentralized. And so you can create a market for anything. You can say, is Andrew Page going to be the next Prime Minister? And you could go on there and
lock it
and bet about that. And that is quite a interesting one, because that leads to like a forecasting market, because everyone kind of battles over odds, and that is interesting. But again, the usage is still very low. So all of these are tiny. Like, it's amazing how much money's gone in there with so little usage. Another one that I have looked at and do own a tiny sliver of, just for interest purposes, is Numerai, which is again using it for forecasting purposes. So it's actually a hedge fund that has kind of outsourced quant forecasting, I guess you could say. So trying to use machine learning to predict the movement of the share market and everything else, but using a whole lot of quants to go in and make that
crowdsourcing it basically, and then locking it on the
using that
blockchain.
coin to pay them. It's something I'm interested in. They're launching something later in the year called Erasure, which is then completely crowdsourcing, allow anyone to go and put forecasts on there. So that's kind of the space I'm looking in, but it's actually been pretty tough to find anything with real world traction. So I guess if any listeners are out there, like if they have anything they think has real world, I mean, people in the real world using it day to day, I think that'd be interesting. It's just, for me, it's been a space I've been learning a lot more about, getting ready to like move forward.
And it's interesting that you raised it as a topic, because it's really just vanished away, and maybe there's a bit of baby out with the bathwater phenomenon there, and it's probably safe to say that 90% will probably still go to zero at some point. And super risky. And you said you own one, and it's a tiny amount. So it's no way advocating it. I don't own any. It's just too high basket for me. But yeah, very interesting.
Yeah, cool.
What do we talk about next?
Moving away from probably about as far away from crypto and hyper new technologies. Woolworths. Woolies.
Yeah, I thought it was interesting. Well, a couple of things. One, it's probably one of the widest held stocks amongst mum and dad investors. So a bunch of our listeners will no doubt have it. And frankly, most of the long-term investors in it, I mean really long-term, have probably done pretty well. This company has been around for a long time.
Yeah, and if you bought 150 years ago, you are sweet.
Yeah, you are sweet. And so it's got this lovely aura with it. It's very defensive, obviously, supermarkets and the rest of it. I think one of the things that's interesting, I made this point on the telly last week, and this is also true of the banks. A lot of these longer term sort of phenomena that you can point to with Woolies and the banks actually is not true when you look at it. So over the last 5 years with dividends, your return has been negligible, less than 0.5% per year. Even if you go back over the last 10 years, I think it's compounded at about 5-6%, but that's just all dividends. So it's kind of moved between 25 and 35 over a 10-year period. That's the share price. But the business itself, I mean, sales are less now than they were 10 years ago.
Really? I guess this is because they cut down some of the areas they're operating in. We're not just talking about a Woolies shop down the road, right? It's more like
there's a couple of phenomena here. So I think the big one is a big structural shift. It was very much a duopoly. And we've had Aldi basically come in, Costco to a lesser extent. There's more coming in that space. Amazon is now doing it as well. So what impact they've had there is, yes, taking some of that pie away, but what's been really fascinating is how much of an impact they've had on margin. So when you have a fairly high fixed cost business, it doesn't take much for your margins to fall before your net profits come back a lot. So net margins over the last 5 years is down from about 8% to 6.4%. Doesn't sound like a lot. That's huge. That is huge. And for my money, I struggle to see how that is going to reverse. When you look at other developed markets around the world, supermarkets don't tend to operate on massive net margins, and that operating margins, I should say. And that's fairly juicy. There's still some ways for it to come back, particularly when you've got people starting afresh here, like the Aldis et al., who will just say, we were more than happy with the 4% yield. We're still better off than we were last year. So for all of these reasons I was talking about last week, I thought shares are a little bit overvalued. But let's get to the news. A couple of things. First, they're going to close 30 Big W's. Big W's just not been doing well at all. They're going to close a couple of DC centers as well. That's going to cost them $370 million to exit that, because you've got to break your leases. There's redundancies. Not so great. But
So they're still keeping it around?
they're keeping it around.
Yeah,
There's still, I think, there's
rid of
180 different stores out
the
there.
worst L's of the big W's.
They're getting rid of the really bad ones,
Yeah.
which makes sense. They've tried to turn it around. There has been some tentative signs of recovery, but just not to the pace that it needs to be. Shrinking to greatness is the term that they like to use.
Shrinking to greatness.
Maybe that's not them, but that's the one that I hear bandied about.
That is a very Spanish term, isn't it?
Well, you're seeing it a lot in the banks too, right? It's just like
Shrinking to
you see these big trends, and it goes all towards sort of consolidation and into new verticals, and then it's like, let's focus on our core business.
Yeah.
And these
We're
trends,
losing to victory.
exactly. It's a bit crazy. So anyway, they're doing that. They've sold the petrol business, $1.1 billion that they've done there. So they got a bunch of cash. So what they announced, in fact, they announced this not long before we recorded here. So I haven't really gone into great detail, but they're looking to buy back $1.7 billion worth of shares. And the question, I guess, of course, is, well, how does that work? And is it a good thing?
How big is that in a share of their market cap? How big is like 1.4 billion?
1.7 billion.
1.7 billion. How big a chunk is that kind of maybe represent?
About 4.2% of the company.
Okay.
It's a very, very substantial chunk.
Yeah.
So one thing that you can say right away is that it's going to increase earnings per share if you just keep things steady. In fact, the way that the maths works, those who do not participate, who do not sell their shares, their ownership of the business will actually increase by about 4.4% or something around that quantum, which ain't too bad.
Yeah. And these aren't as big here, but they're huge in the US, buybacks. Like, it's the main way, because we have tax advantages for dividends. Most companies here don't really do it, but in the US, they're massive. I think the whole US index has a buyback yield, you could say. So like the equivalent of how much they bought back of shares of, 2.5% or something. And some of them big ones even, can be up to 8-9% for some of the large caps. So huge potential opportunities there.
And it's actually being debated a lot in the US as well, whether it's a good thing or a bad thing.
Yeah.
For me, it depends.
Yeah.
And this is where it gets interesting. So, Buffett's talked a lot about this in the past, and he will say that, whenever shares are below their quote unquote intrinsic value, and we touched on this last week, what a reasonable person would feel is a reasonable value for a company. If you can buy back your own shares at less than that's a really good use of capital. You are generating a decent return for shareholders. If you are buying back shares at a crazy price or a silly price or above intrinsic value, that's actually a very poor use of capital. And that's where this is kind of interesting. So let's say that they decided to use this $1.7 billion when shares were at $20. Well, you can buy back a hell of a lot more shares than what you would at $30. So I would say my first reaction was, doesn't seem like the best opportune time to do it. At the same time, they do have a lot of money here that they have to return somehow, and it's more interesting than that, because the way they are going about it is that there's going to be a capital component and there's going to be a fully franked component. So they're actually going to if you participate in this, it'll be a $4.79 in terms of a capital component, and the rest will be made up of a special dividend, which is fully franked. So Woolies has been in operation for a long, long time. They've got this huge bank and franking credits. They are useless to the company. They're totally worthless. They are not worthless to shareholders. So this is a great way to return it, particularly if you were to think, as some do, that maybe Labor is going to win the next election and you're not going to be able to get a cash refund on any excess franking credits. So this is why, and this is where it gets interesting, a lot of people will go, when they look at this offer, they'll say, wait a second, they're offering, that price is yet to be determined. They're going to do a bit of a tender process, but that price is going to be between 10 and 14% below the recent trading price. So you think, well, why would I participate in that? Well, the reason that you would, and the reason why you might actually be better off after tax, is that even if it is 14% cheaper, so maybe that's $26.50 or so, based on the most recent trading price, when you factor in those franking credits, you are probably better off. So I suspect a lot of people will want to participate in this.
So what's your take overall, though, I guess? We talked about the intrinsic value. You didn't think it looked too cheap. So I guess in this case, they're probably buying above what you think their intrinsic value is at. So, yeah.
It's complicated. And as I said, it's just come out. I think on a knee-jerk reaction, it's like, well, if the shares are above their intrinsic value, and they're above what I calculate intrinsic value to be. It's not a great use of it, but there is this wrinkle with the franking credits. Now, I'm never going to be able to do this justice in podcast format, but I would encourage anyone who is a shareholder to get the booklet, get it from the ASX website or get it from Woolies. They've actually got some really handy tables in there for all the various, whether you're in super, whatever tax bracket you're on. And they've come up with some scenarios here will help you work out whether or not you want to participate. The thing to remember is though, although there are some tax advantages and the rest of it, your first consideration should be, do I want to sell my shares in the first place? If you're of the view, and Lord knows I could be way off base with this. So if you were of the view that this is a great company, I bought these, recently with the view to hold it for 20 years, then don't sell just because of a short-term tax benefit. In fact, you will own, your ownership will actually go up about 4.4%. So there's a lot of wrinkles to all of this kind of stuff. It is very interesting. I suspect it'll be very heavily subscribed to. A lot of people will want to participate in it, but do your own research. I'll leave it with that.
Fair enough.
Let's talk
about
shenanigans.
But our shenanigans are cheeky.
Yeah, I mean, his shenanigans are cruel and tragic.
Which makes them not shenanigans at all, really. Evil shenanigans.
I swear to God, I'll pistol whip the next guy that says shenanigans.
Crazy shenanigans.
Yeah.
Those accountants. What are those accountants been up to, Matt?
I don't know if we should blame the accountants. It's probably more like the management who tell the accountants what they want.
That's right. Okay.
So I've been looking at, actually, there's a really good book called Financial Shenanigans that I've been working through. I'd read it a few years ago, but just came back to it. So I'm thinking about ways to kind of quantitatively measure dodginess in companies and kind of use that as a complement to my investing. So the authors are Howard Shillett and Jeremy Perler. It's a book that's was published first, I think well over a decade ago, but it's been in publication for a long time because they keep bringing out new versions. So,
accounting rules change, I suppose,
they change a bit, but it also
people get more
shows,
creative.
Yeah, it shows how popular it is because it is a good overview.
Yep.
And a few takeaways for me, but first I think why you should care about it. The first is if you're buying individual companies, so you're not just buying an ETF, then you need to have some kind of faith in the business is doing what you think it's doing. And it really gets to the fundamentals of trusting a business if you can't trust those financials. So there's a huge number of ways that you can be misled. I don't think any normal investor would be up on all of them, but I think if you have a sense of what's possible, it can kind of give you, maybe you'll see spot one or two, and that gives you enough of a kind of a red flag to dig deeper, or you can kind of put some together and just be a bit more cautious on the company.
So give us one that is easy for us to get our heads around. What's a big red flag that they talk about? Yeah,
so there's a few different types. It kind of gets down to why they do it. So basically, there's the earnings, so profit, which can be manipulated in a bunch of ways to be bigger, or sometimes even lower if you wanted the future to be bigger.
Yeah. So things sort of like underlying, normalized.
You can recognize revenue now, which shouldn't be recognized for a few years. You can make fake revenue,
right.
Which you and I make an agreement so that I give you some money and you give me some revenue back, even though you're just returning the same money to me.
Right.
You can do something one time and make it seem like it's a permanent business. You can pay your expenses later. All sorts of stuff.
There's timing differences.
Yeah, exactly. And I guess the other key point is that it's cash flow as well. It's not just purely earnings that do this.
Yeah.
And there's been some huge examples. It's really interesting reading through the book because it's US focused, but it's every big company you could ever imagine has done something at some point.
Yeah.
There's examples with Microsoft, there's GE, there's everyone.
Yeah.
It's not just a small kind of dodgy companies that do something which has been found to be questionable, I guess, at some point. So that's one, I guess, in Australia. It's interesting to think about how prevalent it is. I think in the small end of the market, it's just they don't even get that sophisticated sometimes.
Yeah.
There had been a big case here with Dick Smith, which
Yes.
Forager had written up as the greatest private equity heist of all time. They do multiple of these, so.
Yes.
A good one from that case was writing down the value of your inventory to zero. So all the stock you have, you say it's worth nothing, and then when you sell it, you make a huge profit on it.
Yes.
They pull all that cash out of the business and then kind of pay it to themselves, or in that case, pay it for an acquisition.
Yep.
Um,
Wasn't Big Air doing a bunch of stuff recently as well.
There's been a lot, Big Un, Big Un.
Sorry, yes,
yeah.
yeah.
So that was a company which the AFR, Johnny Shapiro, wrote a huge takedown
Great
of, really
expose,
good.
yeah.
And they were doing a lot of stuff with cash flow, which caught a lot of local investors out because there's this myth that cash is
king.
Cash is king,
Yeah.
and it's like cash don't lie and all that stuff.
Yeah.
Which would be great. Would be great if it's true, but it's not true. Unfortunately, that is relatively easy to manipulate as well.
But how? How am I going to, in my Ugg boots at home, reading my annual reports, how am I, what are some of the real obvious signs that there's not, here's what I find tricky is that there are often very legitimate reasons to do some of these things. And just because you see, I think it's always dangerous to always assume something foul is afoot. Because there can be, a lot of these accounting treatments are there for very, very good reason. So how do you distinguish between what might be an entirely plausible use of certain accounting rules versus something that seems a little bit dodgy?
Yeah, I guess the first one is to think what they call in the book the breeding ground. So that's probably the first most useful part, is thinking through what are the situations that allow a company to do this manipulation. So, do they have a dodgy auditor from Perth that has like one client and suddenly but they're $1 billion business, that kind of stuff.
Seems a bit unusual.
Unusual. So those like starting conditions are important to think through. Do they have good auditors? Do they have good reputations of everyone involved? All these dodginess generally. And then thinking through, I kind of think of it as like a mosaic. So basically anything that stands out practically. There's things you can look at, like, are accounts receivable growing? Is inventory growing, which means they're not selling as fast? All that stuff, but that's getting into the nitty gritty. You can probably just Google that or read the book.
Days in arrears for that kind of stuff.
Yeah,
you can help
there's all sorts of stuff.
Write in the notes of the financial statements.
I think the biggest catch-all is there a big difference between profit over time and cash flow over time, which a lot of us use. But ultimately it's about just reading through and just seeing, does that make sense? And if it doesn't make sense, digging into it more. And if you can't get an answer to it, maybe kind of lowering your confidence in the company, and putting those little things together in what I would consider like a mosaic of opportunity, of risks, you could say. I guess the other big thing to keep in mind is that some companies are easier to manipulate than others. Banks are almost entirely made up earnings. Like, banks choose what their profit is by their own assumptions. And directionally over the long term, that should be good if they're fine, but it can, that's just one area that
we hear about cash profit versus accounting profit.
Anything financial related, I personally don't invest in that much, partly for that reason, as it is very easy to manipulate. But there's an interesting thing, which I realized from the book as well, is that companies making a lot of acquisitions gives them a huge opportunity for this manipulation, like insane ways they can manipulate. So another reason to be skeptical, as we touched on last week, of companies that make a lot of acquisitions. There's some really flagrant cases in the book where you're about to acquire a company, and so you tell that company to pay all of its expenses for the next year before you buy it, and to not cash any of its checks from customers for next year. So the moment that you buy it, you have the best record ever because they've just prepaid everything, like crazy stuff like that. So there's a lot of...
Is that illegal, like out and out illegal, or is there a lot of discretion there? Like, if it gets proved after the fact, can you just call up ASIC and say... It's a bit of both.
Like, it depends. Like, some of them are completely legal. There was one from many years ago with SoftBank where they acquired a company, and what do they do? No, they sold off a company, but then they agreed to basically a deal where, as part of instead of getting acquisition price up front, they got paid $1 million as revenue every year for like the next 10 years. Like weird, which is all legal, and they would have completely constructed it fine, but it just distorts all of instead of they switch that one-time gain into this long growth in earnings. And just that opportunity, I think, just should make you more cautious with acquisitive companies. And anything where the management, when you realize the management can just make profits be what they want them to be, like we looked at that with some debt collection companies that I know we looked at a few years ago. Even like I was thinking back to RFG, the retail food group, some of the stuff they had where there's just wherever there's a lot of internal accounting stuff and allocation, and you know there's a fund that they take some things away from. Whenever you see that, there's an opportunity there for manipulation. The more you get away from just pure nuts and bolts, the easier it is to...
Simple businesses are really nice for a lot of reasons, but one of them is is it's just harder to do a lot of this kind of stuff.
Yeah, exactly. And again, to your point, I don't think it should be like you spot one red flag and you panic, because if you did that, you'd probably never own anything.
Yes.
And individual companies, there's always going to be some stuff you don't know. But I think just like picking away, you see that loose thread and you keep pulling at it.
Yeah.
Worst case, you end up learning a lot more about accounting and, the way the company works. But in the best case, maybe you find something that's just you can't get a good answer for.
Yeah.
And after you've done a bit of digging, sometimes you can reach out to the company. Once you've done that homework, then you can then you know what they're looking for.
A lot of private investors are really reluctant to do that. They feel as though, well, do I have a right to? Are they? I think if you're going to write to BHP Billiton CFO, you're not going to get an answer.
No.
You'll get something from the IR guy. But you'd be surprised at how willing you are able to communicate with small cap businesses.
Particularly if you've got good questions.
Yeah.
So it's one thing to be like, explain if you just said like, tell me what you're doing that's dodgy, you're not going to get an answer. If you say,
totally
can
reasonable.
you explain these 3 accounting policies, or can you like this number that increased a lot from last year, why is that?
Yep.
And then sanity check it. I think that's the way to do it. So,
especially if you are a shareholder. I know
Yeah.
no one does it anymore, but go to the annual general meeting.
You own the business.
You own. They are your employees.
Yeah.
You've got every right to ask. And maybe if you're a little bit shy, there's always a chance to mingle. I mean, how many AGMs have you been to where there's like 4? Well, you take away the auditors and the staff, there's like 4 actual shareholders there. You can have a really good chat to the CFO and chairman and stuff. And if you've got legitimate questions, they're more than happy to ask them. And by the way, if they're not, maybe that's a bit of a red flag. If you are not willing to engage just for a 20-minute chat with your shareholders, particularly your super engaged, long-term focused ones, then that's a real turn off. I will probably reject a business on that basis.
Yeah,
alone.
I think that's great. And I think the thing to remember, as you said, like this is a topic for another time as well, but you own the company. Like you're not a kind of victim when something happens in a business. You are the owner. Like the company works for you.
Totally.
So you can absolutely expect to and maybe not have a 20-minute call every time that you have any question with the CEO, but you should have the opportunity to have like a good understanding of the business. And if you're thinking about it, I'm sure others are as well. So
one other thing I'll just pick up on before we wrap all this up is that I think I never did any formal accounting at school, university, and I've kind of picked it up bits and pieces along the way. It's a very, sorry to the accountants out there, but it is a very, very dry topic. And it's very number heavy. And for a lot of people, perhaps the majority of people, it's just, like watching paint dry. But I would strongly urge anyone who is serious about being a direct investor to spend some time to get your head around some of the big ideas. As you said, Matt, you can get way down the rabbit hole with some of these things. And I'd be lying if I said I'm across it all. But the big ideas, what is a balance sheet?
Yeah.
How does that work?
Yeah.
What's the structure of the income statement? Why is that important? And there's so many great resources these days for free online, even if it's Khan Academy kind of stuff where there's these really great lessons. You've got to start somewhere. And I think if you do that, it's a bit of work, but the rewards can be massive. A, it can help you avoid some of these big blow-ups that you're talking about. And 2, it just really helps you to understand the economic machinery of a business. Because I think so many of us as investors, we're narrative-based investors. We like the story. Back to crypto again. It's going to change the world. Did anyone actually sort of pick through the use case and understand any of this kind of stuff? Not many people did, but those that did do saved a lot of money.
Yeah, absolutely. It brings you back to numbers. And I think that simple understanding can sometimes be the best, because if you can't understand it simply, there's a good chance they're doing something very complex.
100%.
Which is probably a potential problem.
Yep. Mate, let's wrap it up. We can go have a nice black tea and heal up our throats.
Yeah, sounds good.
Thank you so much for listening. We always enjoy your company, and we'll be back next week with another version of Three Wise Monkeys.
Yep, thank you. Tune in next week.